Good Saturday morning to everybody, and welcome to Mortgage Matters Radio Show with Rob Weinberg. I'm Gary Byron. Rob, how are you, my friend? Good morning.
I'm doing well, thank you.
Nice to see you.
You too.
How's everything been?
Things have been really good, and I'm seeing a lot of great opportunities lately due to the home values going up that we'll be talking about here today.
You know, last week, I wanted to spend more time with this, but I think it's probably more appropriate for today. You started talking about HomeBot, and we gave away something that's normally within your inner circle of clients. We gave away 5 subscriptions to the first 5 people who emailed this radio show. We'll get more into that at the end of the show, but it kind of ties right into today's topic of refinancing opportunities. And I would imagine the way things are right now with interest rates and so on and so forth, you're hearing from a lot of people regarding refinancing. But how would someone know when it's the right time to refinance their home?
That's a great question with really a lot of different answers, but I think the main focus needs to be tracking what's going on with interest rates to see if there's an opportunity from that standpoint. And you can do that through, as we discussed on the last show, the Freddie Mac average rate that comes out.
Right, yeah.
Obviously, people hear buzz in their office or where they work about rates, or they read the paper. So that at least can tee you or give you an idea that there might be an option for you to save money. And the next thing would be home values. Our home values going up. That is a huge reason for people to refinance, to get rid of PMI, lower their mortgage payment, tap equity to do other things with, as we've discussed. And along those lines, you want to do a review, at least minimum of once a year, with whoever your advisor is on your mortgage and your personal finance. You want to make sure that you're looking, if nothing else, just a discussion to make sure that you have the right and the optimal mortgage for your needs. The statistic I heard recently from a publication that I follow called the National Real Estate Post is that 36% of consumers regret not refinancing earlier than they did.
Wow.
Only 25% of people right now in the United States have an interest rate below 3%. So there's a huge opportunity. If your rate's above 3.25%, there's still some great opportunities to refinance and save you money. 13% of homeowners in the United States today have a rate higher than 5% on their mortgage. Every one of those people should be looking at refinancing opportunities. And the last statistic that I'm going to give you is 11% of homeowners have no idea what their rate even is. They just get that mortgage and they never really think about it. And I see it all the time. I've had people tell me, oh yeah, my rate's 4.5. And I look at their mortgage statement, it's actually 4.75. They don't even realize what their rate is. So the tool that I use, which you alluded to keep all of my personal clients in the know, not only yearly, but every single month, is the HomeBot report. This is a personal report that I give away for free to my inner circle clients that will alert you every single month as to what's going on with your home value. Is it going up? Is it going down? Is it staying stagnant? That's number one.
Okay.
Then interest rates. Where is the interest rate currently in the market on a refinance opportunity versus your current rate? Would it save you money? How much would it save you in interest to go to a 15-year loan or to take an adjustable, or all these different factors that you normally need to contact a bank, a lender, a loan officer? This, with artificial intelligence now, with this HomeBot report, people can get this monthly report showing them these opportunities without even talking to anyone. And then once you review that very simple report and see that, wow, I could save $400 a month by getting a new mortgage, or I can take $30,000 in cash out of the equity of my home to pay off debt. Once you see those and get teed off to those opportunities, now you can reach out to your trusted advisor to say, hey, it looks like I can save money by refinancing.
But if somebody already has a pretty reasonable, let's say even a low interest rate, how could it still be beneficial to refinance?
There's a lot of consumers out there that think that because they have this really ultra low rate in the low 2s or mid 2% range, maybe even in the low 3% range, that, oh, it's not going to benefit me to refinance. And that's absolutely false. Because right now, one of the biggest opportunities we have in the state of Connecticut and really across the country is that home values have gone up so much over the last 6 to 12 months, that there are opportunities now, even if you don't lower your rate at all, in some cases, even if your rate goes up, it makes all the sense in the world to refinance. I'm talking about cashing out the equity in your home for home improvements. A lot of people want to do renovations. They want to do additions, redo the kitchen, etc. Where are you going to get the money for that? The cheapest place you can borrow that money almost every single time is the equity in your home with a secured loan, a mortgage against your home equity to be able to get that money out. Next thing is debt consolidation. A lot of people accumulated debt over the last couple of years for a lot of different reasons. Using that equity in your home at the ultra low rate with very flexible repayment terms is an amazing opportunity that you can tap today that you couldn't 6 months or a year ago because the home values were not as high back then. So we have this window of opportunity right now for homeowners in the state of Connecticut, and again, all over New England and across the country, that your home is worth more now. Now is the time. What's it going to be in 6 months? What is your home value going to be in a year? We saw a time in this state and throughout that home values dropped significantly. By the time you went and saw that the values are low, it's too late. If you go and apply for a mortgage when your neighbor just sold their house for a lot less than they should have, or that you thought your home is worth, that could be a big issue. That could be a red flag, and it could prevent you from getting those refinancing opportunities to take cash out. Another huge one that people are doing right now because of all this buildup in equity is they're shortening the term of their mortgage. So they're going from like a 30-year mortgage to a 20-year, or a 30-year down to a 15-year. That's a huge benefit, even if your rate isn't going to go down, that you can still save tens of thousands or sometimes even hundreds of thousands of dollars in interest because we're shortening the term. For people that have tight budgets, what about stretching the term out of the mortgage? Taking a 15-year loan and putting you onto a 20 or 30, that can many times reduce your payment by hundreds or even thousands of dollars a month. Another really common one with divorces, obviously, continuing to be something that's part of our society, taking an ex-spouse or an ex-business partner off the title of the home. A lot of the time, doesn't matter what the rate is, you may have an agreement with them that you have to get them off the title of the home by a certain date. That's where refinancing can come in, because we can take them off that mortgage by refinancing it into your name. If you have an adjustable rate now or have had one from the past, now's the time to lock it into a fixed rate while they're still low. Because again, what are the rates going to be as inflation is running rampant? Right. An inflation report just came out. Yep. Ridiculous inflation going on right now. That is going to lead to higher interest rates. It always has, and it always will. So these rates are going to go up. A year from now, you may not have a good opportunity to refinance, but you do have one right now today from a mathematical standpoint. And if you have a predatory mortgage, like a balloon payment, or like we were just saying, an adjustable payment, you want to restructure that mortgage now while it's favorable, because you may not be able to in the future. So those are all the reasons right off the top of my head that I can say somebody should look at refinancing now, even if you have that ultra low rate.
Oh, wow. I was going to ask you what some of the best opportunities were for it, but you've more or less answered that question.
Let me give you some examples, though, of like a two-punch on how these refinancing strategies can be put together to really create an amazing scenario for a homeowner. So one that I've been doing a lot lately, again, because of the increase in home values, is somebody that bought their home with a low down payment, less than 20% down. They have the PMI, the mortgage insurance on their loan. So here's what we're doing is we're removing the PMI because their home value's gone up. Now they have more than 20% equity. That's the first piece. The second piece is we're taking the money that was going to the PMI and we're redirecting it to the principal. So now they can go to that 20-year mortgage or that 15-year mortgage, and their payment isn't even going up that much at all. In many cases I've seen, people are going from a 30-year mortgage to a 15-year mortgage, implementing what we're discussing. Their payment goes up a couple $100 a month. It's really not that much in most cases if you're in a, decent financial circumstance with a solid job. But the third piece is we actually do lower the rate in addition to those two. So I'll give you an example of a couple that came to me, young couple out of Thomaston, Connecticut. They had bought a house 2 years ago, and they had a 4.5% mortgage. Back then, that was pretty good. But they had the PMI. They had actually used down payment assistance to help with closing and whatnot. And they, at the time, had very little equity. Fast forward to now, they have 25% equity in their home today. So what we did is we took them to a 15-year mortgage from a 30-year. We went ahead and got rid of the PMI because they have all that extra equity, and we lowered their rate from 4.5 to 2.6. And by combining those three pieces of the puzzle together, their mortgage payment is only going up $175 a month to go from a 30-year mortgage with 28 years left down to a 15-year mortgage. It's those combining of strategies together that's really powerful. So that's one. The next thing is just in general, like we've been saying, generally you can lower your rate by going down to a 10 or a 15-year mortgage. And because the rate is so much lower than what most people have, like we mentioned earlier, it was like 25% only have a rate below 3%. So there's 75% of people out there that don't have this. They have a good rate, but they don't have the ultra low, super low rates that are available today that mostly start with a 2. And if we can take them from their current rate down to a super low rate, now all of a sudden we can shorten that term and barely increase their payment.
All right. So then based on that, what are some of the main factors that lenders are looking for when they are evaluating a refinance application?
So in the mortgage industry, we have something called the 4 C's. And the 4 C's are the factors that underwriters and loan officers look at when they're approving your loan. So I want to talk to you about what the 4 C's are and exactly the detail on how they work. So what the 4 C's are capacity, credit, collateral, and capital. Again, capacity, credit, collateral, and capital. Now let's break it down. Capacity is, what is your ability to repay this loan? Meaning, do you have a job? What sort of income do you have coming in? Social Security, pension, etc. That's the first C. The next thing is credit or character. They also call it character. Will you repay this loan? Do you have a track record of repaying loans that you've taken before or not? What is your financial character? If you haven't paid loans back, doesn't matter what type of loan, could be a medical bill that's on your report, could be a credit card. But if you haven't paid those back, then the chances of you paying a mortgage back are much, much lower. So that's why the credit and your financial character is looked at. The next thing is collateral. If you don't repay this loan, is there something of value that you'll agree to forfeit? And that's why the amount of equity that you have in your home typically gives you a lower interest rate the more that you have, because of the fact that there's less risk. If you don't pay that loan back, the lender can sell your property and get that mortgage paid off. So the collateral and the amount of equity that you have in that house is important. And the last one's going to be capital, which plays in with that. What are you worth as an individual? Do you have 401ks? Do you have money in the bank? Do you have a history of saving? Do you have cash value life insurance, stocks, investments? If something were to happen and you did lose your job or you couldn't pay this mortgage back, do you have other areas that you could pull money from? And of course, if you're a homeowner that's been living there for a bit and you've got equity built up, that counts too as part of the capital that you have, because historically speaking, the more equity you have in your property, the less risk that there is that you're just going to foreclose on the house or let it go.
All right. Now, what if somebody's out of work or maybe they have some like unique or irregular income? Can they still qualify to refinance their home?
They can, but there's some stipulations to it. And there's a lot of people that have not a miscommunication, but just misinformation about this. And they think one thing when it's not accurate. So if you're retired, legitimately retired, and you're getting money from Social Security, pension, or IRA, 401k, you absolutely can get a mortgage. It's just a little bit of a different documentation process on what you need. But just because you're not working doesn't mean you can't get a mortgage. If you have irregular income, like it fluctuates, a lot of nurses, traveling nurses, and other people that work in the industry, they have irregular income where it fluctuates. So typically with irregular income, you're going to need to have a 2-year history. And the underwriters are going to look at a 2-year average with those type of positions. So I had somebody contact me earlier saying, hey, I'm starting a delivery service, 1099, and I want to get a mortgage next month. Not going to happen. There's no history there. With those type of jobs or type of positions, you have to have a 2-year history in order for us to be able to use that income. And like I said, normally the underwriters are going to look at a history of that over the last 2 years. So if you made $50,000 last year, but you're going to make $100,000 this year, it really depends on, what was the year before that. If you went 50,000 in 2019 and 50,000 in 2020, and now this year you're going to make 100,000, they're not going to just use the 100,000. We got to, again, look at the average and make sure that that's on track. So unemployment is something that a lot of people think that they can use to get a mortgage, which is not true unless it's normal and customary. So I have a client that I work with who's he works on the roads in Connecticut here, and he does not work typically 3 or 4 months out of the year. When it's really cold, those guys are not working. So he gets unemployment every year like clockwork. Those are the scenarios where we can use unemployment because he gets it every year. There's a 2-year history, and his employer verified that it's normal and customary to get that. He's going to continue to get it in the future. But the person that just lost their job and is getting unemployment for the first time, you can't use that to get a mortgage because it's temporary.
Even through COVID.
Even through COVID, it's temporary. Yeah. So if you're going to use that unemployment income, you need to have a history of that, and you need to have a relative assurance that it's going to continue. The normal timeline is they want to confirm you're going to get that for at least the next 3 years. That's the timeline that they want to see that you're going to get something like, a disability income or a unemployment income like we're talking about. So it is possible, but there are certain stipulations as we're discussing.
Can you mention maybe some of the benefits of refinancing with cash out versus taking like a home equity line of credit?
This is a really common question lately because home equity lines of credit and people have these low first mortgage rates and they're like, well, I don't want to touch my mortgage because I'm at 2.5% and a cash out refinance is going to be at 3%. So I don't want to do that. I'll take a home equity line of credit. I used to offer home equity lines of credit and I don't anymore. And I advise a lot of clients whether to take them or not. And I will tell you, in this current economic environment, with inflation running rampant, with rates on the rise and will continue to, a home equity line of credit is one of the riskiest things that you could get. It's like putting a credit card on your house because a home equity line of credit is an adjustable rate by definition. So it can fluctuate up and down. Depending on your agreement, the rate might change every 6 months or it might change once a year, but it's putting you in a risky scenario. On a fixed rate cash out refinance, we are locking that money in at a specific rate and it can never change. So for most individuals right now, unless they plan on selling the house guaranteed in the next couple years, for sure, those are the only ones a home equity line of credit will really make sense for. Otherwise, I think taking a slightly higher rate on a cash out refinance is well worth mitigating the risk of the rates going up in the future. What are you going to do when that home equity line of credit goes from 3% or 2.5% to 5% and your payment goes from $300 a month to $700 a month? I've seen it happen. And that's when people panic. They contact their mortgage lender and they say, I got to refi. I don't know what to do. I have to get rid of this adjustable rate. You're at the mercy of the market then. If the rate's 6%, you got to take it. You just got to get out of that adjustable.
So I guess I'm maybe answering my next question. Why would somebody want to refinance now to consolidate their debt versus, let's say, a year ago?
I think refinancing for any cash out reason, or really for any reason at all for that matter, is better now than a year ago because there's more equity now. Okay. More equity is going to give you more access to cash. It's going to give you better loan terms. It's just going to give you more opportunity. And the PMI, like we were talking about, you might have bought your house a year ago and had PMI, and now we can get rid of that PMI because your home value's gone up 10 or 20%. As crazy as that sounds, it's happening all over. We don't know what the future is going to be. These opportunities have not been available for years and years in Connecticut. The real estate market in Connecticut has been in a slump for a very long time. It's now not. It's now all of a sudden it's a hot market. We are playing on the same playing field as California, as Oregon, as Colorado, these states, Florida, where real estate's been doing great. Well, Connecticut has been lagging behind, and it's only in the last 12 to 18 months, really even less than that these opportunities have really come up. More specifically in the last 6 months that we've really just seen this stuff accelerate so much, and the rates are still so low. That it's so worth it now to look at those options.
Well, for now, folks, you are listening to Mortgage Matters Radio Show with Rob Weinberg. You can check out his website at www.robgw.com. I'm Gary Byron. I'm going to ask you one other question, and then I kind of want to switch gears and talk about something that we talked a little bit about last week, and we certainly did at the beginning of this show. But what about using a cash-out refinance to maybe to buy other properties or invest in a business, let's say?
Really popular right now. People are opening their minds to these type of things because, again, a couple years ago, they didn't have equity. Now they all of a sudden do. So the opportunity is there right now. Like we were saying, you're going to get more money today cash out refinancing your property than you would have gotten a year ago, 2 years ago, or more. So if you've been thinking about buying another property, if you've been thinking about starting a business or using your equity for anything we're talking about on this show here, now's the time. Because again, we don't have a crystal ball. But what I will tell you, doing business in Connecticut for almost 20 years, is that the market here, it changes on the drop of a dime. As we've seen, these home values skyrocketing, well, they're going to come down too. And you want to refinance, you want to tap that equity, you want to take advantage of these opportunities when they are opportune, which is right now, the best time, not when you have to and you have no choice. If you're thinking even any time in the next couple of years that you're going to need to tap your equity, get positioned now, get the strategy in place today, get that money in the bank, because you're better off borrowing it and not needing it than you are needing it and not being able to borrow it because the home value's gone down or because your credit went, to a bad scenario and you can't qualify. God forbid you lose your job. I mean, how many people out there had a reduction in their hours or a job loss and had all this equity in their home?
Right.
They didn't tap it. They said, oh, I don't need to do that. I don't want to do that. Well, by the time you're getting notified that your hours are reduced or the pandemic hits or something, you can't access that equity because you have to qualify for that loan. The saying is the banks want to lend money to people that don't need it. Once you need it and you have no job and you're in financial straits and your credit is bad, you're not getting a loan, buddy. I mean, that's the fact. Take that money, seize that opportunity while you can and while the market actually allows you to, both from an interest rate standpoint being so close to historically low and an equity standpoint. It's very rare in the history of real estate that you have super low rates and really high equity, and that's what we have today, right now, in Connecticut.
All right. I kind of want to switch gears, as I mentioned a moment ago. I want to talk about something that's called HomeBot. You went into it a little bit last week, and at the top of the show, you said we discussed it maybe a little more in depth. It makes sense because it really pertains to refinancing opportunities. I know this. I know that it's something that you exclusively offer your specific clients. It's not something that the average consumer can just go, I'm listening to this. I think I'll go to their website and I'll download it
you can't
or
buy
the program.
You can't just go sign up. You have to be invited by a mortgage lender like myself.
Right, exactly. I know we're going to make a special offer to some of our listeners in a few minutes, but before I get there, I'm going to turn it over to you, and maybe you can give a better explanation what HomeBot is.
Absolutely. So HomeBot is an artificial intelligence engine that tracks home values and different opportunities in regards to real estate. So what happens is once you get loaded into HomeBot, your address will be in that database. The HomeBot program will track all the information on your property, from the mortgage or mortgages that you've had in the past to the one you have today, what interest rate you're paying, what the home values are going for, what the trend is of home values over the last year or two. Are they going up, down? It will actually show you a graph to show you what's been going on and tracking that home value. Then it will identify different refinancing opportunities for you. What's the going rate on a 15-year loan? You can look right on your HomeBot report. And this is a report that comes out every single month. It's mobile friendly. You can pull it up right on your tablet, your smartphone, or computer. And it's very simple, very aesthetically pleasing, very easy to read, very simple. And it will show you not only that home value we were talking about, but how much equity do you have in your home? How much could you pull out to buy a rental property? How much could you take to consolidate debt? One of the coolest features is it links up with Airbnb, and it will tell you how much you could rent your home for on Airbnb. Maybe you're going to be out of the country or out of state on a vacation for a couple of months, and you want to rent your house out. How much would you be able to make by doing that? It tracks all that, and you can inquire. You can ask questions in there, and they will be forwarded to myself or whoever your mortgage expert is in order to answer those questions, but it will tip you off to the opportunities that we're talking about, so you don't have to constantly be worrying, should I refinance? What's the rate? How much equity do I have? Just pull this report up once a month. It'll get emailed to you. You get notified when it's available. You click the button. It comes up. You see what your house is worth and how much could you save by refinancing, how much could you get out in equity, etc. And then you can decide, should I look at options right now in depth or am I in a good position right now?
And mention really quickly about a filter in case you wanted to. You've done some remodeling. And
so one of the things that's a huge issue with other home value sites like Zillow or Realtor.com is that you can't really tweak the value very easily on those sites. What if you've done a renovation? What if you've done a new kitchen or added a bedroom or done something to the property and it's not reflecting? HomeBot makes it really easy with a couple clicks for you to tune the value. So when your HomeBot report comes in, you can hit tune value and it'll come up with a bunch of options to tell it, how do you want to tune your value? What have you done? You can say, I added a bedroom, I renovated my kitchen, I added a pool, all these different things, and you can actually use a slider tool to say how much you think your property's worth, and it will then go in and verify what's going on in the market. Now, a lot of people discount an online tool like this because they've had a bad experience with a Zillow or another type of home valuation tool, but I will tell you, HomeBot is the most accurate I've ever seen. It pulls data from a service called Black Knight, which is a data service.
So, in order to obtain this, a person can't buy this. They would have to typically be your client. However, if you are one of the first 5 people right now, don't even wait for the show to be over. I'd start emailing right now. If you're one of the first 5 to email this show, Mortgage Matters Radio Show at gmail.com, you will automatically be enrolled. Now, when you do that, in your email, please provide your address, your phone number, and your name. This is going to come right out to you. Again, right now, be one of the first 5 to email Mortgage Matters Radio Show at gmail.com. Incidentally, you can also use that email address if you've got a question that you'd like to have Rob answer, either in private or perhaps even on these very airwaves next week. Check out Rob's website at www.robgw.com. Again, robgw.com. And his phone number is 860-413-3938. Again, Rob's phone number, he can be reached at 860-413-3938. For Rob Weinberg, I'm Gary Byron. Thank you so much for listening to Mortgage Matters Radio Show. Until next Saturday, have a good one, everybody. So long.